After surviving an incredible 52 votes of confidence in his political career, Silvio Berlusconi has finally been forced from power. But Italian debt yields remain stubbornly high and the markets seem unconvinced about Italy's ability to balance the books. I'm joined by Luca Mezzomo, who's the head of macroeconomic research at Intesa Sanpaolo. Luca, yields on government debt remain high in Italy. At what point does it become unsustainable?
It very much depends on growth prospects for the future. With an expectation of 1% GDP growth in the long run, I think that an average cost of debt of about 6 to 6.5% will be entirely sustainable for the Italian economy, because it would involve a primary surplus between 3.7 to 4.5% to stabilize the debt ratio. So I think that such levels could be sustainable, and consider that we are starting this year from an average cost of debt which is going to be more or less 4.1%, which is going to rise to about 5% next year, assuming that the spreads remain as large as now.
Looking at the Italian debt situation, as a percentage of GDP, government debt has remained above 100% for the last 30 years or so. So are the concerns around Italy based on fundamental problems, or is it just a crisis of confidence?
I think that it is based mostly on a crisis of confidence, which of course also has some fundamental roots. Clearly, in a situation of distress for the euro area markets, to have a very high debt ratio makes the country more vulnerable to stress. And so the level of a debt ratio, which is not a problem in normal times, can become an issue in periods of economic distress. That said, I think that most of the problems we're now facing are related more to a liquidity crisis than to a solvency crisis, because it would not be so difficult for Italy under normal cost of debt to stabilize the debt ratio and even to reduce it at a fairly high speed. Actually, the medium-term fiscal strategy under better conditions in terms of cost of debt would lead to a fairly quick decrease of the debt ratio between now and 2015.
Does a change in government actually do anything in terms of implementing austerity measures?
I don't think that it will change much in terms of the fiscal correction, because most of the fiscal correction for the next 3 years has already been defined, and there is very little room for maneuver for any government coming in the next few months. It can instead make a big difference in terms of the structural reforms that could be implemented in the next few months. And so I do think that a change of government can lead to a different outcome for this crisis in the future. In addition, I would say that this confidence crisis is very much related also to the persons currently ruling the country, and so it is important in this situation to have some sort of change, also to show to investors that the country is willing to change tack for the future.
Italy does have very sluggish growth, and that has been the case for the last decade now. And it also has this huge amount of debt. If it is to significantly reduce the debt burden, how will it be done?
Well, I think that it is not reasonable to expect a huge decline in the debt ratio in the next 2-3 years. Also taking into account that the growth is likely to be around zero for the next couple of years. I think that there are two ways in which the situation can improve also on that front. First, by keeping a primary surplus large enough for a long period of time, between 5 to 10 years, just to start cutting by 1, 2, 3 percentage points per year the debt ratio. Second, there might be the need for extraordinary measures in the forms of asset sales or even a wealth tax or other forms of extraordinary revenues, one-off extraordinary revenues to be raised in order to decrease the borrowing requirement by a large amount next year. in order to reduce the dependence of the country from subscription on new bond issues by non-residents.
That was the head of macroeconomic research speaking to me from the largest retail bank in Italy. We'll keep the quality interviews coming here on Dukes Copy TV. Goodbye for now.